Elf Beauty just reported their earnings, and currently stock is down about 24%. They're trading at $66. In full disclosure, I started buying Elf when it was in the early $100 range, and then I averaged down at about $88 and today at about $72. So I currently own 45 shares at $98 cost basis. So I'm down about 30% now. And let's look at what happened in the most recent earnings. They did beat the revenue target by about 7.54%. The EPS was a miss of 2.55%. Street was expecting 76 cents and they reported 74 cents. That's a slight miss. Now let's look at what they have done in the most recent quarter. They increased their sales by 31% year over year to $355 million. So that's impressive. The gross margin is about 71%. That's incredible for the business that they are in. The net income was $17.3 million, which means they are profitable. And when you look into their fiscal outlook, earlier they were guiding for 1.315 billion to 1.335 billion. Now they reduced that guidance by a little bit. If you look into it, the difference is not too much, 1.3 billion to 1.31 billion. And they also reduced the adjusted EBITDA from 304 to 308 million to 289 to 293 million. That's also a slight reduction. And the reasons for the stock decline are obviously the lowered financial outlook. When a company gives some guidance and reduces it even by a little bit, that looks bad on them, and that has caused the stock to decline. Whether 25% decline is justified or not, only time will tell. And also, Elf got hit with analyst downgrades, as you can see on the screen. Prior to the earnings announcement, Piper Sandler downgraded Elf stock, reducing the price target from $167 to $131. And that also contributed to 5.3% decline earlier this week before the earnings. And the CEO is saying that the slowdown is due to the hangover from holiday discounting and changes in the way people were posting online amid the potential TikTok ban. We know that Elf does a lot of marketing through social media, so it looks like that took a hit. And they also said the new tariffs against China also weighed in, and the company is preparing. They used to have 100% of their manufacturing in China. They are reducing that exposure. Currently they are still at 80%. They are working to reduce it even further. So the future outlook, despite the recent setbacks, Elf reported 31% year over year growth, and that's not easy, right, for the industry that they are in, unless they are taking market share away from other players. And they're saying that the beauty industry remains highly competitive with major retailers like Amazon and Walmart and shorter trend cycles influenced by online influencers. So let's look at the Elf's valuation. I'm still sticking to my previous valuation that I have shown in the video in which I said Elf can double. They increased their revenue by 31% year over year in the most recent quarter. And the revenue may slow down because the global makeup industry and skincare industry is in a slowdown. We are seeing the likes of Estee Lauder and L'Oreal, etc. They are posting slower growth, but it's going to recover. And when it recovers, the growth has to reaccelerate, and that's why I'm estimating average of 25%. I'm also uh, putting 25% for Elf growth because they are doing international expansion. They are entering a new sector, new segment, that is skincare. They only have 2% market share now. With the acquisition of Naturium, they can gain market share there, right? So it's not too difficult for them to make about $4 billion by 2029. Currently, they are close to 1.3 billion, and in 5 years, I'm saying that they can almost triple their revenue. So I have the same net profit margin, 17.5%, and a 30 multiple, and I put 3% dilution. This company is profitable. They have close to $70 million of cash and $160 million of debt. So I'm still assuming 3% dilution. I'm estimating $281 by 2029, and that's 321% gain from the current price of $66. And if they do great execution, then the stock price could be $500. I'm not expecting that the great execution case will happen like I do in almost all my videos. I only go by the reasonable assumptions case in which I'm looking at a 4x. So I think $66 is a very good entry point for someone who did not enter this stock. Of course, I was too early. That's why my cost basis is $98. I think it's a good price to average down. Again, this is not financial advice. I'm not qualified to give financial advice. I'm simply doing my analysis based on the valuation that I posted here. Even if I reduce the growth rate by a little bit, I think I should still get more than $200. So I'm very optimistic about this stock. They're well positioned. If you look into their business model, I have discussed that in my previous videos, so please check them out if you did not watch my previous videos on ELF. They're well positioned, they have good balance sheet, they have good margins, they are profitable, they're very innovative, and they are also taking market share from a lot of other competitors, and they are entering new sectors and doing international expansion. They give quality ingredients for a reasonable amount of price. Yes, the tariffs can be a headwind, but everybody gets everything from China, so every company will get hit if Chinese tariffs are about 10%. So I continue to be very optimistic about ELF. I think the risk reward is amazing at $66. I'm very confident that it could get to $200 by 2029 unless something drastic happens. Of course, I am always worried about my investments. I'm worried if I'm not worried. But I think there is no better risk reward setup than ELF at this moment. So I'll continue to hold my shares, and if the stock price goes down, I'll continue to add. And as usual, I'll stick to 5% rule in which no single stock can be more than 5% of my portfolio with respect to the cost. So I'll max it out at about $6,000 to $7,000. So currently it's at $4,500. So I have another $1,500 to $2,000 to add. So I'll continue to dollar cost average into this stock. Let me know your thoughts in the comments. Thanks so much for watching.